Hello and welcome to the Pro Forma Models live modeling of how interest rates impact loan proceeds and ultimately asset values. Let's pretend we're looking to buy a property for our own personal owner occupancy. This means the underwriting is based off our income. Let's utilize $100,000 as the annual income for this example. The mortgage for the property will be paid monthly, so let's convert the annual income to monthly by dividing the annual income by 12. You can decide how much of your income you are willing to set aside for mortgage payments by stating the monthly mortgage payment as a percentage of monthly income. In this case, we will use 50% as the mortgage-to-income ratio. Multiplying the mortgage-to-income ratio by the monthly income will provide the desired monthly payment. In our case study, the $100,000 annual income becomes $8,333 of monthly income, which at a 50% mortgage-to-income ratio results in a $4,167 monthly payment. For our example, let's utilize a mortgage term of 30 years. This means that adhering to a standard payment schedule with no prepayments or refinancing the mortgage will be fully paid off with a zero balance in 30 years. For the case study, we will assume the mortgage is paid monthly through the term. Multiplying the mortgage term of 30 years by the number of payments per year, which is 12 in our example, results in the total number of payments through the loan term, which is equal to 360 in our example case. The interest rate will be the changing variable in our calculation. Let's analyze from a starting rate of 1.5% up to 10%. We are going to calculate the present value of a loan given a fixed monthly payment, term, and number of annual payments and a changing interest rate. This present value of the loan can also be viewed as the loan proceeds available to borrower at the selected interest rate, term, number of payments, and the desired fixed monthly payment amount. We will now calculate the present value by utilizing the built-in present value function within Microsoft Excel. The first input for the present value formula is the interest rate, which is the variable input in our analysis. Please remember to divide the interest rate by 12 to get the monthly interest rate. The second input for the formula is the number of payments, which we calculated as 360 in this example. The final formula input needed for our analysis is the desired monthly payment, which is $4,167 in our example. Hit enter and the formula yields a result just over $1,200,000. This value can be interpreted as a 30-year mortgage with monthly payments of $4,167 at a 1.5% interest rate will result in loan proceeds of just over $1,200,000. Copying the formula to the right will show the present value of the loan, also known as the loan proceeds, given a fixed monthly payment of $4,167, a 30-year term, and monthly payments at the various interest rates. Observe how the present value of the loan decreases as the interest rate increase and other assumptions are held constant. Our analysis looked at interest rates from 1.5% to 10%, which is a range of 8.5%. The present value of the loan changes from over $1,200,000 at 1.5% interest to just under $475,000 at 10% interest. This is a range in loan proceeds of over $700,000 over an 8.5% change in interest rates. Observe the loan proceed reduction per 50 basis point increase, with the largest reductions occurring at the low end of the interest rate curve. Think about the potential impacts on asset value, both in and out of the real estate space, as the Fed continues with a hawkish stance with impending interest rate increases. The Excel file prepared in this video is available for free download by following the link in the video bio. Thank you for tuning in. We hope you enjoyed this pro forma models walkthrough and encourage you to visit our website to try the model for yourself.